Thank you. The work of extraordinary social enterprises, such as those we've just seen, and those sitting in this room, is indeed the heart and soul of what inspires so many of us, including those we have the privilege of hearing from next. Led by Robert Craybill, the managing director of IIX, we'll now have a chance to learn more about the impact investing landscape in Asia. But first, a few words about Rob, whose steady leadership has been integral. Before launching into social entrepreneurship, Rob was a senior finance executive with 2 decades of experience in the capital markets with investment banks such as Morgan Stanley, Credit Suisse, Wasserstein Perella, and Dresdner Kleinwort Wasserstein, and as a private equity investor. He came to Asia 8 years ago as the head of Asia ex-Japan investment banking for Dresdner Kleinwort Wasserstein, and most recently was head of Asian private equity for Marathon Asset Management. Rob brings to IIX his significant knowledge of emerging markets in Asia, which includes being senior advisor to Asian Tiger Capital, an innovative financial services boutique, helping to facilitate investment in Bangladesh. Rob is an enthusiastic alumnus of Princeton University and the University of Pennsylvania School of Law, and he has served as an adjunct professor in the MBA program of Singapore Management University. It is a delight to now turn the floor over to Robert Craybill for our opening plenary, Impact Investing in Asia. Rob.
Okay, thank you very much, Sue. Good morning, everyone, and thank you for joining us today at Impact Forum 2012, and welcome to this session on impact investing in Asia. We're absolutely delighted to be hosting a global conference dedicated to impact investing and social entrepreneurship here in Asia, and we're especially excited to welcome many visitors from overseas to Singapore, which is fast becoming a regional hub for supporting social enterprise and impact investing in the region. Many of the discussions we'll be having today and over the next 2 days will have global relevance, but we also hope to leverage the collective experience of the group here to develop a particular understanding of Asia's unique perspective in this sector. Social enterprise and impact investing are a global phenomena, but they're playing out in slightly different ways in different regions. We need to understand what makes Asia unique while also learning from best practices from around the globe. This plenary aims to kick off that conversation. We're fortunate to have with us a distinguished group of panelists representing a wide range of different players in the sector. And before I go further, let me introduce our panelists. First, and to my far right, is Justina Lai, who is with the Rockefeller Foundation. Justina focuses there on Rockefeller's Harnessing the Power of Impact Investing initiative, as well as on their program-related investment portfolio. As we've just heard, as many of you know, Rockefeller Foundation has been a leader in the development of the impact investing sector globally through their support for research and for the development of crucial enabling infrastructure in the sector. To Justina's left is Mr. Asif Saleh. Asif is Director of Strategy and Communications at BRAC and BRAC International, and is also the head of the Social Innovation Lab at BRAC. BRAC, based in Bangladesh, is the world's largest NGO focused on development, and the Social Innovation Lab that Mr. Saleh manages focuses on harnessing innovation within BRAC and incubating creative ideas to solve social problems. To Asif's right is Mr. Wolfgang Hoffenmeyer, Managing Partner of LGT Venture Philanthropy. LGT Venture Philanthropy combines both venture philanthropy and impact investment, and is active supporting organizations in Latin America, Africa, and here in Asia, with a very major presence in both South Asia, Southeast Asia, and East Asia. Before I turn the floor over to the panel, let me spend a few minutes to set the stage. We're gathered here in Asia at the start of an Asian century for a discussion on Asia's role in the global impact investment movement. As you'll probably hear a few times during the course of the 2 days, and you may have heard a few times already today, over the past several decades, Asia has witnessed unprecedented growth, which has lifted millions, hundreds of millions of people out of poverty. And yet, substantial challenges remain. Some of these challenges persist despite the rapid growth and reflect that this growth has not been as inclusive as might have been hoped. Other challenges exist as a result of rapid growth, including environmental degradation, increasing stresses on water supplies, and the need to adapt to climate change. To address these challenges, many NGOs are developing financially sustainable social enterprise models to supplement, or in some cases replace, traditional donor-driven models. And at the same time, a new breed of for-profit social enterprises are using for-profit structures to access investment capital to fuel growth and amplify their impact. Asia has been at the forefront of these trends as a hotbed of innovation in social enterprise. First, as the cradle of microfinance, and more recently, as an emerging leader in such areas as bringing decentralized renewable energy solutions to scale, and as a pioneer in innovative, affordable healthcare solutions. In order to support these trends in Asia, in 2010, the Asian Development Bank launched a multi-year research and development technical assistance program focused on supporting the development of platforms for connecting impact investors and social enterprises in Asia and the Pacific. In some ways, this forum is the culmination of that program, and throughout the next 2 days, you'll hear a number of references to the outcomes and results of that work. One such outcome was a report, Impact Investors in Asia, published in 2011, copies of which are available outside and on our website. I'd like to take a few moments just to touch on some of the findings of that report, which surveyed both active impact investors in Asia as well as potential impact investors with an interest in Asia. Most encouragingly, a majority of those surveyed indicated that they were willing either to begin making impact investments in Asia or to increase their activity in the region, but with the caveat that this was subject to the development of appropriate market infrastructure in the sector. And I think it's instructive to look at some of the items that were cited by these investors as prerequisites for increasing investment activity in the sector. Among investors who were not already involved in the industry, the biggest concerns were easier access to impact investment opportunities, as well as more information about the availability of these opportunities. Others were also waiting for evidence that impact investments could actually deliver promised financial returns. Among those already active in the sector, the most widely cited impediments to increasing their investment activity were the need for increased transparency of both social and environmental impacts as well as financial results, and the desire for a greater degree of liquidity, that is, a better established path to exit investments once they had been made. These are challenges that each of us working to expand the impact investment sector here in Asia need to take up. The report also provided some interesting indications of the future direction of the impact investment sector. While investors reported that most of their investments are currently direct investments, that is, investments made directly into the debt or equity of social enterprises, investors who were new to the sector expected to make much greater use of indirect investment structures, investments through funds, through advisors, and even through funds of funds as they entered the market. Similarly, while most impact investments today take the form of private equity or privately negotiated loans to social enterprises, investors are looking forward to a future with a much broader range of impact investment products, including publicly traded equity securities and liquid debt securities. Another trend that we see here with particular relevance to Asia is the evolution of the investor base from one dominated by Western investors to a more balanced investor base with a larger proportion of the region's impact investment capital originating from within the region. Now, without further ado, and with that introduction, let me call on Justina to give us a global perspective on the impact investing sector and the Rockefeller Foundation's vision for its development. Justina?
Is this on? Oh, great. Thank you, Rob and Doreen. and IIX and Shujok for organizing this Impact Forum. Really excited to be here, and thank you, Professor Tan and NUS for hosting us in this beautiful venue. Dr. Roden was, I know, really disappointed that she couldn't be here, but I'm really excited to be here to represent the Rockefeller Foundation and our views on impact investing. The first question you might ask is, why is a foundation even talking about investing and spending so much time talking about investing? Well, I think as you've heard from a number of folks already, we know that our resources, even when combined with all of the resources available in philanthropy and public dollars, just are not enough to solve the world's social and environmental challenges. To just give you a sense, in the US, about $50 billion is deployed each year in the form of grants. $200 billion is available in bilateral aid. And that sounds like a lot of money, but in comparison, it's a drop in the bucket when you look at the several trillion dollars that experts estimate will be required to provide and secure adequate housing for all of the people in the world. And so in order to have the impact on the issues that we really care about, we know that we really need to harness just a portion of the tens of trillions of dollars available in the capital markets. And not only the capital, but also the creativity and the innovation that exists in the private sector in order to have, the change that we care about and move beyond traditional NGO models to hybrid and for-profit business models that intentionally create social and environmental impact. It's also the right time. There's a number of converging forces that are driving the interest and activity in this space. First and foremost, both investors and consumers are increasingly looking to align their purchases and their investments with their values. Consumers are really demanding fair trade, organic products, and investors are increasingly rejecting the binary where they're being told they can only make a lot of money on one side and give it away on the other. They're recognizing that there are ways in which you can combine that for greater good. I think there's, as we all know, increasingly complex challenges in the world and increasing inequality and inequity globally. And so there's a new generation of talent that's recognizing this and thinking that they want to make their careers in impact investing in social enterprise, in ability to do good and do well at the same time. You can see this in the impact investing and social enterprise curricula that exist in universities around the world and in business schools around the world. And that's all driving a lot of talent into the space. Governments are also recognizing the potential and the need for this activity, and so they've created a lot of enabling policies to catalyze impact investing and social enterprise activity. They have provided capital. I don't know if you all saw, but Big Society Capital in the UK has just committed to £600 million, I think is the right amount, to support the development of intermediation vehicles for impact investing in the UK. And that's in the UK alone. There's a lot of policies, obviously, here in Asia and Singapore. The Singaporean government has been incredibly supportive, as in the US. And finally, I think there's a recognition that the lack of sustainability is a real business and investment risk. And corporates are recognizing this, and they're also recognizing that there's a real opportunity in this space. And so that's really driving a lot of the interest in what Professor Michael Porter and Mark Kramer of FSG called shared values, in which corporates are looking for ways in which they can incorporate positive social and environmental impact into their business practices and operations. And this is, as you can tell from the diverse individuals in this room, the interest is coming from all different places. So it's not just the foundations and the development finance institutions, as you would expect, but also banks like JP Morgan, Morgan Stanley, Deutsche Bank, Bank of America Merrill Lynch, are all establishing, UBS with their values-based banking group, they're all establishing social finance units within their banks and putting not only their capital, but their talent in order to capture some value in this marketplace. Pension funds like TIAA, CREF are involved, high net worth individuals, family offices, and each and every one of us can have a role. So there's a lot of interest and activity coming from all different angles. You know, Rockefeller began its initiative in impact investing about 4 years ago, as you heard from Dr. Rodin. You know, impact investing was not new at that time. It was certainly practiced in different subsectors, microfinance, community development finance in the US, and you know, some of the development finance institutions have been doing this for decades. But what we recognized was all of this was happening in silos and in you know, fragmented activities. And so our goal in catalyzing or committing to the impact investing space through our initiative was to really capture that uncoordinated innovation to really start to build a marketplace. And so we've been doing that by catalyzing collective action platforms like the Global Impact Investing Network, in which investors can share best practices and advocate, the Aspen Network of Development Entrepreneurs. We've also been supporting the soft industry infrastructure that's required in the space, so the metrics like impact reporting and investment standards, the rating systems like the Global Impact Investing Rating System, really to provide the tools to investors and entrepreneurs to not only measure but communicate their social and environmental performance and impact. We've been supporting the scaling of innovative intermediation vehicles, so social impact bond work globally, as well as folks like Rob and IIX with their Impact Partners platform, to really provide the intermediation capabilities to, for those who are looking to place impact investment capital into the social enterprises that generate it. And finally, we've been you know, producing research papers and really looking at policy design and analysis to better understand how we can create an enabling environment for impact investing. You know, there's been a lot of talk and excitement in the impact investing space for the past couple of years, and it's now time, I think, that, you know, we've created the tools and the infrastructure that are required, but it's now time to move beyond talk to real action, to start developing the track records that are required in order to demonstrate and capture the value of the marketplace. And so I think it's, you know, you take a look at Asia and the fact that growth is coming more and more from outside the traditional economies of the West, and the wealth that is being created in financial hubs like Singapore, Hong Kong, and Shanghai, and the need to really catalyze those regional platforms for impact investing activity. The ADB and BART and Jareen, Rob, IIX, and Shujok have all been leaders in doing that here in Asia, but we need more, and that needs to continue. Similarly, we've, you know, at the Rockefeller Foundation been focused primarily on the supply side of capital, but obviously recognize that supply and demand go hand in hand. And so you can't, there's a real need also to support the impact enterprises that will be the destinations for this impact investment capital. And Shujok's been very active in that, Change Fusion and other organizations here in Asia. But that needs to continue, and the Rockefeller Foundation has been following the lead of those great organizations and have been exploring how we can be helpful in supporting the field of impact or social enterprises. So stay tuned for more on that in the next couple of months.
Okay. Thank you, Justina. Wolfgang, you head a global organization in the impact investment sector with a major presence here in Asia and throughout the region. I'd be very interested to get your perspective on, as an investor, of the sector globally, as well as your perspective on the impact investment sector here in Asia.
Good morning. Thanks a lot for being here. Thanks a lot for the invitation. I don't want to be the one who spoils the party, but I think coming from the action, and we were talking about action just a second ago, I want to bring a little bit more of realism into this whole game. I think if we forget this whole sector of microfinance for a second, because I mean that's an industry which is existing for the last 30 years, which is already at a stage where it's very commercialized, where it's far beyond the early stages of an industry, where it has its challenges, obviously, where it had a few problems the last 1-2 years, but where it will recover, change a few things, and will grow nicely. If we forget about this part and talk about the impact investing space, which I think a lot of people think about when they come together here. This part which was created over the last 5 to 10 years. Then what I would say we observe globally, but at the same time here in Asia, is that we're still at an extremely early stage. At an extremely early stage in a sense that despite all the differences which we see in the different countries, and I would say if we have a look at Asia, there is huge differences. I mean, for me, talking about impact in investing in Asia is really difficult in a sense with teams on the ground in China, as well as India, as well as 4 Southeast Asian countries. And in all of these places, the situation, if you want to act, if you want to invest, is completely different. You cannot compare them. And that's also true for African countries that we're active in, for the Latin Americans, and also for the Europeans. But what's almost going through all of these countries is the very simple fact that you still have to have a look at thousands of different organizations, and you find very, very few of them which are really at a level of professionalism where as an investor you would want to invest with them and work with them over the next 5 to 10 years. Just to give you an idea, globally we had a look at around 5,000 organizations the last 5 years, which all have been recommended to us out of our local networks. So it's not been blind proposals to us. It's been recommendations out of our local networks, and our local team member who are all locals in the countries, they're really networking a lot in the different countries. And out of these 5,000 organizations, we are invested in 30. Not all of them that we declined did a bad job, but what goes through is that the level of professionalism in these organizations is very often still very charity-like. And that's why bringing realism into this whole field, I think it's just important to, at least in this group of professionals in here who all come together to learn from each other, to be honest about what works and what doesn't work. It doesn't help us that much if we talk and celebrate ourselves already at this early stage. I think it's still time to be very humble. We know about all the big challenges out there. We know, or we feel at this moment, that we have an approach which can help us solve a lot of problems, but over the next couple of years we have to prove it. We have to prove it, at least coming from a European perspective, have to prove it before we go out and celebrate ourselves. The job is still to be done. It's good that we see places like Singapore, places like Hong Kong, where over the last 5 years especially, I would say a lot of ecosystem was built. But that's just 2 comparatively small points in the whole of Asia, and there needs to be a lot done in all the other countries. I mean, just because now we have a few tools and a little bit of infrastructure does not mean that we already have the professional management teams in the different countries, that we already have all the entrepreneurs who go for solutions, build teams around them which help them to scale. So I think having a look at Asia, I would say Southeast Asia and China are at an extremely early stage where we have lots of very small initiatives, I would call them, rather than organizations, not to speak of companies. What we see as well in these countries is that through initiatives like the ADB initiative around inclusive businesses, there is slowly companies getting interested in this field, which might open up in venue over the next couple of years to do larger investments. But still, in these countries, there's a lot to be done around accelerating with business know-how, accelerating comparatively young organizations and helping them to grow. Accelerating with money, and with business know-how, a strong combination. If you have a look at countries like Taiwan, like Korea, like Japan, I think they are still very much focused on the inside, and activities in our space just started over the last couple of years. For them to take a role throughout Asia will still take a while, because what we've seen very often, these countries first do a few things in their own countries, and once you have people who are active in their countries, then they start to look beyond. India is completely different in a sense that the whole industry is way more vibrant. It's there for way longer. You have way more opportunities at all different stages. So there, a lot can be done. It has its limitations still in other respects, but let's say from a development of the industry, I would say we're at least 10 years ahead in India right now. So I think one of the messages is throughout Asia, it's very different if you have a look at the different countries, which at the same time, as a consequence, means that you really have to have people, if you want to come to action, you have to have people on the ground who really understand what's happening in the country and who really see where the opportunities are, because it does not help to throw money at things which are not existing. So people have to understand what's possible in the current setup. And another message for most of these countries is that what I see on the ground is that the talk which we have in a lot of conferences is not reflected in reality in terms of the amounts of opportunities are not there, but also, and I think that's a decisive point from an investor's point of view, the amount of money which should be invested is not there. I mean, sometimes it sounds extremely strange to me when I hear that there's 3,300 millionaires in this region and a net wealth, a net wealth of 10 trillion. And then if I have a look at what the people who co-invest with us, our friends out in the field who do the investments with us, invest in this space of impact investing at the moment. I mean, this shows how humble we should be at the moment, how much work has to be done to convince more of these high net worth individuals to take risk, because to invest in early stage companies is a lot of risk. To convince them to take the risk and come along with us. Because what we've seen in other places around the world, as long as there is no money, you don't attract the talent which you need to create these solutions. At the same time, and then coming to the positive side, what we all know as well is that there is tremendous challenges in the environmental and social field. And when I'm talking about impact investing lately, I'm just asking people, because people ask a lot what is needed to bring this to a next level. And in the end, for me, what's needed is to really change the frameworks of all the investments which are done outside the impact investing space. Because very simply speaking, if we assume that impact investing is investments which want to have a positive financial return and at the same time a positive societal, social, environmental return, then we must ask ourselves, what is all these other investments? By what did all these other 3,300 millionaires make their 10 trillions in net wealth? Did they do it by investing with a positive financial return, but a negative social, environmental return? A negative societal return? And then we should ask ourselves, should this be investing which should still be allowed? So I think instead of focusing on the small part and how we can grow this, I would sometimes wish that more people would take measures to make sure that all these trillions are not allowed to be invested in a way that they have to destroy first what we then with a little money try to solve afterwards. That's somehow a very ridiculous state. And I think we can talk about a lot of things which are necessary. Of course, it's necessary to have ecosystems which are built here and which are built elsewhere. Of course, it's necessary to have accelerators working with young social enterprises. Of course, it's necessary to have money available for inclusive businesses and to help them. But what's needed for me first and foremost is that we make sure that it's not allowed to invest in a way where we destroy all the social fabric and create all the environment problems that we then have to solve with a little bit of money. And I think when we take a step outside of our cocoon here, then that's what we sometimes should make very, very clear, and not be shy when we talk to normal investors, because actually what they're currently doing, they're destroying the basis for our well-being. And I think we have to be very explicit about this, and by this hopefully create a dialogue which helps us to have a different set of supporters and a different framework out there. Thank you.
Good. Thank you, Wolfgang, for those provocative comments. I'm sure we'll have some questions on those. But thank you. Let me turn now, though, to Asif Salah. Asif, BRAC is, on the one hand, one of the world's largest development-focused NGO, but it's also spawned a number of very successful social enterprises. What's been the secret to BRAC's success, and what can we learn from that? And what are you doing now?
Okay, I'm going to quickly go to the podium, and I actually will try to reintroduce BRAC in a minute and a half for those who are not familiar, kind of just to show the evolution. So if you could play the video, please. This is a short minute-and-a-half video.
BRAC, formerly the Bangladesh Rural Advancement Committee, is the largest non-government organization in Bangladesh and in the world. Fazl Hassan Abid is its founder.
Country like Bangladesh with 130 million people, you need to have large-scale programs, otherwise you don't bring about any significant change.
BRAC's 30,000 staff members serve over 4 million members with healthcare, nutrition, microfinance, legal aid, and other services. Over 1 million children attend BRAC's non-formal primary schools, and only 20% of its work is funded by donors.
There's a market perspective in everything, including even in development programs. You'll find that there is thinking about whether we want to do this at this cost or something alternative at that cost. These are being looked at all the time.
Abid shares with us his views on why it's so vital to think big, how to properly lay the groundwork, how to guide the process, how to employ important checks and balances. He demonstrates the importance of involving everyone to work toward a single, higher goal.
In the 70s, there was a book by Schumacher, Our Small is Beautiful. It encapsulated a thinking about any program which is big is not very good. I mean, small is beautiful. It was somewhat a Gandhian kind of principles that big means a big factory where people are dehumanized. Small is beautiful in the sense that you do things, you produce things yourselves and so on. But we felt that in terms of development programs, whatever you do in Bangladesh, if it is too small, it's insignificant, it doesn't solve the problem of Bangladesh. And we decided that if you want to tackle poverty of the country like Bangladesh with 130 million people, you need to have large-scale programs, otherwise you don't bring about any significant change. So that became our motto, that small is beautiful, but large scale is absolutely essential in Bangladesh.
Okay. All right. Actually, that's not the video I meant to show, but it gives you somehow there was a screw up on the top. But the idea behind it, what I wanted to kind of highlight was that before impact investment, social enterprises became buzzwords. I mean, we basically started using marketplace as a key intervention in our development areas. So if I could just briefly give you a story, in terms of, we talked about microfinance just a little while ago, and BRAC started microfinance in the early, like mid-70s. And when we started microfinance, one of the things that happened, we saw that you know, these are basically areas in rural areas where there's absolutely nothing going on in the economy, right? There's no employment. The whole point was to generate employment, how you can make people earn more money, as simple as that. So when microfinance came in a village, typically in a village, what do people do? They actually start buying some assets which can generate some income. So they buy cattle, they buy cows, a lot of cows. And suddenly in a one single village, if everybody buys cows, they produce a lot of milk because they actually sell those milks. And what happens in the basic economics 101, when there is a lot of supply of milk, not enough demand, the price goes down. So as a result, what happened was we saw that price of the milk was going down, so the real purpose of income generation, sustainable income, didn't really serve. And then one of the things that BRAC actually makes BRAC's approaches unique is that relentless pursuit to results. And in my former life, I used to work for Goldman Sachs for 12 years. There is a similarity in results-driven approach, but slightly different perspective in terms of what kind of results. So BRAC's focus was very much on social impact. And so it went back and saw that what it can do in terms of improving those livelihood opportunities for people by selling those milk. So and there was a shortage of milk in the urban areas. So they went back and then actually said that why don't we actually create those chilling centers around the people, around those villages and those areas where there's milk being produced, and kind of create the entire supply chain to sell those milk in the urban areas where there's a shortage of milk. So that's how BRAC Dairy started as a social enterprise. And it wasn't all hunky-dory in the very beginning. I mean, it actually bleeded money in the first 2-3 years, like most other businesses. But now BRAC Dairy is the second largest milk production house, and very much profitable. So that just gives you an idea. The idea behind it that when you actually bring in the market intervention and increase the sort of the demand and give rural people or the people who doesn't have access to market, the social enterprises, or if you call it impact investment, these are very much part of development interventions. So that's how BRAC saw it. It never saw it that it's actually, the expectation was not there that it's actually going to make money from the very beginning, or it's going to make a lot of money for us, but it actually came from a social intervention. So if I could kind of quickly step back, and a lot of people ask that, what is BRAC? I mean, it's a, end of the day, it's a nonprofit organization. But there are lots of different, 3 separate streams that BRAC has, which is, one is the development interventions, where we have health, education, and all these different approaches, which actually where we give the services. And this other approach is the social enterprises, which actually generate surplus for us to pay for some of these development interventions we have. And then on the third stream is the socially irresponsible investments that we have, where we basically made this calculation at some point, our founder, that overseas money or the grant money that's coming in, it's not going to last forever. So at the end of the day, the organization has to be self-sustainable if it wants to continue these development interventions. So that's where the socially responsible investments came in, so that it actually can generate assets and money in the long term for the organizations. So BRAC enterprises are basically somewhere between profit-seeking organization and social organization dedicated to serving social objectives. I mean, how are we different? I mean, there are 3 basic principles: people, planet, and the profit. I mean, this is all something you guys are aware of, but I'm not going to get into too much into these details. But I guess where we stand in terms of the business motive spectrum is somewhere in the middle, where you have, on the one corner, you have these exploitative businesses, and on the other corner, you have the charities So we are somewhere in the middle. So that's where the social enterprises, and specifically focusing on enterprises of BRAC here. It's always very tricky to finding the right balance. I think this is something I think every social enterprises struggle. But one good thing we have is that that we are not tied to capital market. So as a result, we don't have very strong pressure from shareholders to move to that left side. So we can actually be safely on this right spectrum as well. I'm not going to get in too much into the values, but these are some of these guiding principles and the values that provides BRAC's work. But let me just get into some of these the core principles on how these social enterprises actually play a role. I mean, this is basically the 2 + 2 = 5 effect that we talk about. I mean, this is an example I already gave in, that this is a series of interventions when we actually start thinking about it as a chain of events. That when a village organization member starts taking the loan, then she buys the cows with the loan, and she buys and the cow would actually need some feeds. Again, imagine yourself in a rural area where there's no feed mill. So this is where those interventions, so BRAC actually started a feed mill. Breeds a cow with a hybrid cow semen. So you wanted to actually improve the quality of the cow that you have. So where do we get the artificial insemination sort of provider? So we actually created people who actually gave them training to do that. So these were all kind of social enterprises interventions that came in. So this kind of gives you the glimpse of how in various areas, when we actually went to the rural areas and we actually tried to create an entire ecosystem around a particular sector, whether it's poultry, whether it's dairy, whether it's rural artisan getting access to markets. So we kind of thought about the entire ecosystem and created enterprises around that. And the ultimate kind of the guiding principle was that the poor are not necessarily be passive recipients of aid. They can do things for themselves, and they only need to be empowered and enabled to analyze the situation themselves in order to find a way out of exploitative processes. So you build the ecosystem, you train them, and they will find a way out of the poverty. I mean, this is a great example of the Shondharani we actually talk about when we talk about our own. She's an artisan, rooted in poverty, denied access to the economic system. And to gain access to the economic system, she needed to be empowered. And for her to be empowered, there's 3 vital resources she needed. She was basically needed education, protection from diseases, and access to finance. So those are all development interventions, which gave Shondharani access to economic system. But there was something missing. Which was the access to the market itself. When she was actually making those products in the rural areas, and Doreen, the founder of One Nest, knows more about this, that how critical is not only the access to the market, it's actually maintaining the quality, giving them access to the raw, sort of the quality input. So those are the areas where BRAC came in and established this retail outlet called Arong. I mean, our inception to that journey was from 1978. It was the year we began exploring ways to engage the poor in the Manikganj district in Bangladesh. And sericulture was identified one such activity which would help earn these women some form of livelihood. And very soon we learned that these women could not, I mean, the livelihoods they earned could not be sustained unless the hand-spun silk they were creating could be successfully marketed. And so Arong was created. Arong is a retail outlet in Bangladesh. It's now the largest retail outlet as well, and set up to offer a fair return to women in sericulture program and link them to the urban markets. So right now we have about 65,000 rural artisans employed through this Arong in 2,000 villages. 25,000 independent cooperative groups and traditional family-based artisans sell their crafts through Arong. And Arong is directly benefiting about 320,000 people. This is just an example, and it is actually a hugely profitable entity for us as well. Again, dairy is a similar story. I won't get into too much into that, those details, but among BRAC's 18 different kinds of enterprises right now we have, again, I kind of gave an idea about how those were originally created as a support to development interventions. Those are all kind of profitable entities right now. Poultry is another example where we actually went in there when nobody else was there. So we had to kind of prepare, not only invest on the sector, but we actually had to prepare the people who was actually vaccinate in the rural areas. I mean, we actually had to prepare the feed mills for them as well. So this is kind of the long and short of the way we have actually used enterprises to actually extend our development interventions. And if I can stop there right now, and just to give you some numbers, I mean, as I was saying, that sustainability was very much built into the BRAC's ethos from the very beginning. I mean, right now, eventual goal is to become 100% self-sustainable for the organization. And even 30 years ago, we were about 70% driven by grants. Now it's the flip side is true. 70% is self-sustained and 30% is driven by donor grants. And when you're talking about the $600 million revenue of a company, that's a pretty sizable chunk. So I think the story, what is the headline here? I think the headline here is that not necessarily that you actually have to, you can calculate from the very beginning how it's going to all evolve. But when you actually have the bottom of the pyramid market targeted, you actually build some capacity within the people themselves and kind of look at the entire ecosystem. There is not only a tremendous amount of social return, but actually you can actually generate a lot of financial return yourself as well. So with that, I'll conclude, and then if there's any question, I'll be happy to take that.
Great.
And just to kind of, Rob, sorry, you kind of asked about what's next and those kinds of things. I think actually that's a very interesting question, because this is something we are having a lot of internal debates on as well. And we are currently looking at secondary schools. I mean, primary schools were free, and we provided the education for free based on development grants. But now we're looking at low-cost private school system, which actually provides quality education, but it's actually going to be a fee-based social enterprise. So this is something we're exploring quite actively and working with Pearson, the education company, right now in partnership. Thanks.
Great. Thank you, Asif, and my apologies about the video. We have now about 15 minutes for questions. I have a few that I'd like to ask the speakers, but we also have microphones set up here, and anyone who has a very big voice can stand up, and I'll acknowledge you. But I'd first like to ask, I mean, Wolfgang, you gave us a little bit of sobering advice and pointed out that here in Southeast Asia and East Asia, the impact investing sector is very nascent. It's only about 5 or 10 years more advanced in India and some of the markets in the West. But that still is a head start. What can we learn from those markets? What are some of the things that have worked or in those markets that we need to try to build in here in Southeast Asia and East Asia as we grow? Both to you, Wolfgang, and Justina.
I think that comes back to what I said before. All these different countries are extremely different in their setup. That's why I'm hesitant to say what worked there will work here in Asia as well. On the contrary, it might not work here. I mean, if we have a look just at the basic setup of how the private sector works with the third sector, how government is involved, things which are possible somewhere in Latin America or in Europe are absolutely impossible in China, for example, at the moment. So I would be very careful in saying we can learn an awful lot. I think what's needed is to really understand the different countries. And the things which can be learned are not rocket science. I think you can even learn more from how business developed in these countries, to be honest, because we're nothing but businesses which want to create a more positive impact and try to avoid all the negative impacts that we have. So the typical infrastructures that you help to grow normal businesses in a country normally also help to grow the companies that we need here. It's not too different. So I would say rather have a look what worked in these countries in terms of developing good local businesses and then applying similar ecosystems for this sector as well. Because that's, for me, it's, we always try to make of this something super special, which for me it is not. It's just we have senior management teams with a different attitude, with different values, who don't maximize financial returns, but try to create companies where they create positive externalities in the best way, but for sure no negative externalities. And so for me, I learn more if I have a look at what worked in the business world in these countries instead of applying something which worked in a completely different country with a completely different setup and different players.
I mean, I agree with all that. I think everything needs to be context and geographically appropriate and specific, and frankly, even sector specific. So, you know, if you're talking about agriculture versus health, it's very, and versus education, it's a very different story. But I still think there are some generalizable principles. Again, none of it's rocket science, but I think it's worth repeating that, you know, this just takes time. Some of this is purely, we just need to be patient. But I think there's also a need, you know, on the demand side, so on the enterprise side, I think there's always a need for support, and that support will differ, again, based on geography and based on sector. But there are sort of platforms that you can think about in order to incubate these, and again, it just takes a lot of time. On the supply side, I think there's just a need to be much more clear in our language, in the language that we use, and about what flavor of capital we're bringing to the table. So there's a lot of different risk-return profiles that people are looking at, different levels of impact, both depth and breadth, that people are looking for. And you know, the impact investing term is meant to be quite an umbrella, broad term that encompasses a lot of different types of players looking for a lot of different things. And I think we all just need to be much more clear about where we're trying to play in the space. And then we can be much more thoughtful about how we can combine that capital. So there's ways in which right now you can layer capital. You can take grant or concessionary forms of capital that can provide principal protection to those who are not willing to take as much risk. And that's a way in which you can leverage an additional capital and bring a lot more capital at scale. There are ways in which, you know, in general, to take business principles, you know, microfinance required a lot of subsidy in the very beginning, and that was because, you know, it was perceived to be very risky to lend to poor individuals. Well, subsidy and then, you know, pure grant capital and then more concessionary forms of capital that weren't looking for risk-adjusted market rates of return were able to demonstrate a track record, prove the creditworthiness of microfinance borrowers, in order to eventually build a marketplace, you know, 30 years down the road that is, you know, accessing pure for-profit commercial capital.
Just a very small comment there, because subsidies always sounds that negative. And I don't think it needs subsidies, but it needs investors willing to take risk. If you have a look at the digital world and how it developed in the 80s, 90s in the States, in the late 90s in Europe, there have been billions invested in companies which are not existing anymore, and billions were lost. We're only talking about the ones that are still surviving, Google, Microsoft, etc. But there have been billions invested in companies which are not there. But what it did, it built the ecosystem which now helps for us to have this whole infrastructure. And we try to make things worse than they are. It just, as you said, it needs time and it needs a lot of risk to bring these new sectors, these new industries to the size that we'd like to see them. And there's absolutely nothing bad about investors taking risk and investing money in bringing to what they want to see.
Thank you. Let's take a question from the floor. Let's see if the microphone works.
Yes. Hi, my name is Lina Green, and I had a question with respect to what I see as the confusion right now in terms of what people mean when they say impact investing. And I think that came out from the different perspectives the speakers obviously had. That one of the things that concerns me is everyone's kind of, it's hyped up of this area because there's the opportunity to do good and do well. But we also have the opportunity of doing good and doing really bad, not necessarily financially, but as you know, the road to hell is paved with good intentions. And so my concern right now is that while I think it's really good that we have this good intentions, we want to channel it in the right way, I'm wondering whether a certain level of market segmentation might help people recognize that it's going to be very different in different segment markets. Particularly, I'd like to refer to the JP Morgan report that came out about 2 years ago on impact investment. If you really read through the financial details, you notice that really they're not looking at the bottom of the pyramid. They're looking at areas above $3 in a day. They're looking for social returns, but really similar financial returns as well as to other investments they make. Whereas the BRAC report, for example, you've shown that if you start off with wanting to do good and you do it the right way with sort of a bottom-up approach, in the long run, you might have the financial returns, but again, not quite the same returns that the JP Morgan report is talking about. So I'm just curious that, is there an opportunity for us to clearly do market segmentations so that we can more effectively channelize money and the right people, but at the same time try to avoid the road to hell with good intentions?
So I think the short answer is yes. That's what I was attempting, perhaps not so eloquently, to say was, I think we need to be much more clear about different flavors of capital, and not only within the impact investing space, but we need to place impact investing within a broader context as well. And so the goal here, philanthropy will always be required. This is my bread and butter, right? I'm not trying to put myself out of a job. Public dollars and pure grant subsidy will always be required. It's just that there's not enough of it. And so we need to take some of the, and pure for-profit capital is not evil either, not all of it. And so it's really about recognizing that there's this whole spectrum of capital that's available out there. And it's about, well, what problem are you really trying to solve? What's the right intervention to solve that? And then what's the appropriate form of capital to finance that intervention? Capital is just a tool. It's not the end in and of itself. And so I think, absolutely, I think people just need to be, I don't know if it's any person's particular or institution's particular role to define that market segmentation. Certainly that research can be done. But I think it's all of our responsibilities collectively when we speak and when we ask questions of others to make sure they're very clear about where they're trying to play and what the different trade-offs, which aren't necessarily inherent, but what the possible trade-offs are between what they're looking to do and what they're going to be able to achieve. So to your point about JP Morgan's report, you're right. The type of investments that they're talking about there are never going to reach the bottom of the pyramid, but that's partially what aid and grant capital is for as well.
I think the first thing which helps is that the definition, how it's stated in this report, tells you nothing about the target group. It includes all target groups. It just says investments which have a positive financial return and a positive societal return, intentionally and measurable. So that does mean that it's perfectly fine and it's a perfect impact investment if you invest in renewable energy, which is for large cities. And there's all different levels of society in a large city. Whereas when you have a look at the people active in the field, the different investors, they very often have a very specific target group. Like, for example, LGT Venture Philanthropy explicitly says we're targeting less advantaged people. So for us, even though we're an impact investor, I am always saying we're an impact investor with a philanthropic aspiration, which means that our target group is only less advantaged people. So we will not do impact investments which target middle classes or upper classes. But the term itself doesn't differentiate there, and I think it's fine. It's just, it's about us to see, okay, which investors play in which field. I mean, a huge disservice I think the report did in general is to claim that impact investing is an asset class, which for me is, well, just not true. I mean, just read through the report and then see that all different asset classes are invested in, as we have just seen here, and you see that it's not an asset class. If you follow the logic which I had before, then all investments should be impact investments because it should not be allowed to invest and create negative social, environmental, societal returns. So if you assume that all investments in the future should be impact investments, then obviously we will see different asset classes, and venture philanthropy belongs to the asset class of alternative investments, more precisely in the venture capital asset class. And within this asset class, you can then target different target groups. And then I think it's pretty simple and easy, and you can segment the different things quite well.
And we can actually provide a lot lower rate of interest than any other countries because of that. That there's a development interest which is core in this approach still, even though it's still not a it's not a donor-driven entity anymore. And I mentioned the high school low-cost private school example that I gave. And here we are working with a very much for-profit company, and this tension is coming in, that in terms of, we are talking about improving learning outcomes, quality. So how do we, and they're also saying that, the same thing, but also we know that they have shareholders they're answerable to. So how do we come to that agreement where it needs to be clearly identified that this is the amount of financial profit I'm going to get, limited profit, but at the same time the decisions are going to be based on learning outcomes as well. So when you actually make that decision on resource allocation, you need to look at the learning outcome, whether it's improving learning outcome, rather than whether it's improving the financial bottom line. So,
Thanks, Asif. One more question, Tim?
Yeah, Robert, I was just going to maybe ask the question that Asif has partially answered. As many would perhaps look at BRAC, if they had invested in BRAC as an impact investment in 1971 when it was initiated, as a huge success. And you gave us a great sense of the diversity of enterprises that have grown up over the last 40 years. But you didn't tell us much about the type of investors in those enterprises. Who were the investors and what were their terms and conditions? Were they all the same, or was there a big diversity which might talk a little bit to the sorts of different, managing different aims and objectives, of some of which you've just talked about a little bit?
Right. So in the 70s, 80s, and 90s, there was not much diversity in terms of investors because it was mostly grant money that came in. I think that's quite crucial. And that's why we could, like you're saying, we could experiment a lot. We actually built up all these training facilities all around the country, which came of use really later on to actually train these various people. But so it's it purely came in. I guess the uniqueness of the approach was that we actually used market as an extension to the development interventions we kind of facilitated. So it was originally known as program support enterprises. So when you actually work with the agriculture program, you want to give them high quality seeds, but you want to create a system around it. So we created the seed enterprises around it. So that's how it came about. But then at some point it became self-sustaining organization, self-sustaining enterprises, because so the seed money, I would say, came from grant money. But now the dynamics is, and the separate stream I talked about is the investments, the social, where BRAC actually established separate entities altogether. So for example, the BRAC bank that was set up, purely the social motive was setting up, helping the SMEs, the small and medium sector enterprises. So people who graduate out of microfinance and get to that next level, where do they go? So they actually want to get the loans from the bank. So that's where we kind of moved to kind of create a separate entity, and we actually asked for investors from outside private sector entities as well, private sector enterprises. And where that's also was driven, the profit motivation was blended there as well. So in those cases, we actually went to the private sector because this was kind of set up as a sort of socially responsible for-profit investments. And now there's a third stream, third wave, I would say, that are coming in, which is like I was saying, the education sector, where we are now realizing that development grant money is drying up, and that's the future. Is if you now start now people in, especially particularly people in Bangladesh, if we look at Bangladesh is slowly starting to get to graduate to a middle income country in the next 15 years. People's earning potential, spending potential have gone up. The problems, social problems that we faced 20 years ago has evolved. So primary school access was a big issue at one point, but now that access issue is not there anymore. It's the quality is the main issue, and parents are willing to pay for that. They're spending a lot of money in private tutoring. So can we actually provide a social benefit, but at the same time charge a social fee, charge a fee so that it's actually sustainable intervention? So now we are, from the very beginning, now we are thinking that we are going to actually look into the private sector money and create an enterprise around it. So I don't know if that answers the question.
Okay. Thank you. We have a lot more to talk about, but I'm afraid we're out of time for this session. Not to worry, we have 2 full days of panels to continue the conversation on. So for now, though, let me just ask you to join me in thanking our 3 wonderful panelists. Thank you, Justina. Thank you, Asif. Thank you, Wolfgang. And invite Sue to tell us what we do next.
Great. Thank you. And thank you again to all of our panelists and for that important conversation. We've been talking a lot about taking action, but clearly a very important thing that we need to do is to define what it is that we're taking action on. What are the hard questions, as well as the ones that everyone is already enthusiastic about. So thank you. So I think that also serves as the perfect springboard for our first set of breakout sessions, which start at 11 o'clock. As a reminder, track A is Philanthropy to Impact Investing, which will be in the building next door in the Kent Ridge Guild House's inner chamber. If you are attending track B, which is Measuring Success, How to Know When You're Making an Impact, you'll be right back in this room. And track C, Connecting Markets Through the Ecosystem, will be in the building next door as well, in the Kent Ridge Guild House Clooney Room. There will be caffeine, coffee and tea available, both right outside these doors and in the building next door. So you'll have refreshments wherever you are, don't worry. And lunch will be at noon, also next door, in the Kent Ridge Guild House banquet room on level 1. There is assigned seating for lunch. Think of it as a big impact investing wedding. So do be sure to check the back of your name badge for your table number, and that'll tell you where you're going to go. Thank you. A couple more things. Don't forget to sign up for the social enterprise showcases, which are for accredited investors only. So find out if you qualify to preview deals on impact partners. And there's also Impact Academy, which will be held tomorrow morning. So please do sign up for that. You can do both of those things at the registration area downstairs. For those who have general questions throughout the day, we have 2 information desks. One is right downstairs again, right by registration, and another on level 1 of the building next door, Kent Ridge. And 2 final items before we break. First, we'll be tweeting throughout the forum. The hashtag is ImpactForum2012, so follow us and add your own tweets. And finally, as you leave the auditorium, and you might have already seen this already, you will see images of beautiful paintings on display. The pieces in this Igniting Colors for Change collection are available for sale, with proceeds benefiting the work of Shujog and Global Women Forum, whose work empowers women and assists social enterprises. Many, many thanks to Global Women Forum founder Rekha Modi for her generous donation of these very powerful artworks. And that concludes our opening session. Thank you again so very much, and have a fantastically impactful morning. Thank you.